Hello, I'm Kip Robbins, the Chief Investment Officer at Retirement Plan Advisors. Today we will spend some time together talking about recessions and bear markets. Many Americans equate recessions with bear markets. They might say that they're the same thing or happen at the same time. So what's the difference? In fact, recessions and bear markets are very different. The National Bureau of Economic Research defines a recession as a significant economic decline lasting more than a few months, as measured by gross domestic product, workers' income, employment rates, manufacturing output, and retail sales. So what causes a recession? Because consumer spending comprises 70% of the U.S. economy, recessions are triggered by large declines in consumer spending, typically caused by shocks to the system. They can be an internal shock like the tech bubble in 2000 or the Great Financial Crisis in 2008, or an external shock like the pandemic we're experiencing now. Economic recessions and expansions are part of a normal cycle. That's something to remember. Since 1945, there have been 12 recessions occurring every 5 years on average. Recessions last on average less than 12 months. Economic expansions typically last much longer, more than 4 years on average. So what's a bear market? A bear market is typically defined by more than a 20% drop in the stock market, and these are usually associated with widespread pessimism and negative investor sentiment. Given the definitions of recessions and bear markets, we need to remember that the economy is not the same thing as the stock market. So recessions are not the same thing as bear markets. Recessions reflect significant declines in the economy, and bear markets reflect significant declines in the stock market. Recessions and bear markets don't always happen at the same time. Let's look together at their frequency and connection. There were non-recessionary bear markets in the fall of 1987 and then again in the fourth quarter of 2018. In the early 1960s, there was a recession before a bear market. Bear markets can occur around the same time as recessions, about 50% of the time. Another one-third of the time, bear markets actually precede recessions. The remaining 17% of the time can be a combination of different events, including a bear market without a recession or a bear market after recession. So while there is a connection between recessions and bear markets, that connection is an imperfect one. So what does all this mean to you as an investor? The key fact about recessions and bear markets is that after a bear market and before a recession ends, stocks tend to move up. The chart shows the performance of the S&P 500 index during recessions since 1945. You can see that the stock market has averaged a 4.76% positive return over those 12 recessions. There were 5 time periods that were negative: 1957, 69, 73, 2001, and 2007. But as you can see, 7 of those 12 recession periods produced positive results. Because the connection between recessions and bear markets is imperfect, we cannot accurately predict what will happen in the short term. To recap, we need to remember that recessions and bear markets are not the same. They don't always happen at the same time. Stocks tend to move up over the long term, especially near the end of a recession. And the most important part is to remember your investment strategy should be a function of your time horizon and your personal circumstances, not current events. Invest for the long run, not for the short run. Thank you for your time today, and remember, the future is better than you think.